For our next session, one of the things we wanted to do with the Future of Social Ventures conference was to present a variety of perspectives within the social impact space and the impact investing space. And our next speaker is no stranger to this impact investing space. She co-founded Tideline 3 years ago, which is a consulting firm that specializes in helping institutional clients that want to start impact investing strategies. Kim Wright-Violich spent 11 years before that at Schwab Charitable, building it up from scratch to one of the largest donor-advised funds in the country. And she is involved in a number of other philanthropic and social impact efforts as well, like Echidna Giving, which focuses on evidence-based approaches to advancing girls' education in the developing world. On top of all of that, she finds time to serve on several boards, including the board of our Center for Social Sector Leadership here at Haas, for which we're very grateful. I'd like you all to join me in welcoming Kim Wright-Violich. Thank you.
Thank you so much. Okay. Well, thank you very much for that introduction, and it's fun to be here. I taught for a little bit at Haas, and I have a daughter who was a Berkeley student and a stepdaughter who was a Berkeley student and a Haas student, and even though I went to that little farm across the bay, I'm very attached to this place, which I know is blasphemy, but I am. Some of what Rich talked about, and you're very lucky to have a dean who's both smart and approachable, because I think he does embody that confidence without attitude. But that beyond yourself piece I was going to talk about a bit, because that is what this whole sector is about. It's less about what it's going to do for me and more about what it's going to do for others. I thought I'd start just because I think it's interesting sometimes to think about people's careers with a little bit on my career. I know it was touched on briefly, but it's not linear, it's not strategic. Just to give you some sense of how crazy it has been, I was a biology major at Stanford, and my first job out of college was Union Carbide. And now I'm in the impact investing space. Do you remember Bhopal? Does anybody even know what Union Carbide was? So that tells you that careers don't have to be linear. But in 1999, I decided I wanted to make a change, and I went to a career coach, and I'd been sitting on nonprofit boards, and I thought I want to have a marriage between the private sector and the social sector. And I looked at, there wasn't much going on at the space. Impact investing wasn't a term. Social enterprise wasn't really a term. And I looked at, Bain was launching Bridgespan at the time, so I talked to them. I understand that you guys have had some exposure to the Omidyar network. At the time, it was just the Omidyar Foundation, and Pierre had not quite decided that the private sector was something that he wanted to leverage. And Schwab, I had heard that Schwab was starting this thing that they were going to offer to investors to stimulate philanthropy. And somehow I got myself there, and by some miracle, they made me launching CEO. And then we built that thing to about $5 billion in contributions and $3.5 billion in assets in 10 years. That experience made me realize that the private sector moves much more powerfully and quickly than the social sector by itself. You can't start, and technically Schwab Charitable was a nonprofit. Donor-advised funds are nonprofits. You can't launch a nonprofit and 10 years later attract $5 billion if you're not delivering a service and meeting a need. So to me, it was a visceral experience about what happens when you align markets and a social change movement. At the same time, I was watching the Gates Foundation, which at the time had about $32 billion in assets, and it was more narrowly focused on childhood immunization. And they weren't being successful at immunizing every child in the world, despite the fact that they had $32 billion. And that made me realize that it reinforced this message that philanthropy is not the answer. And so then is government the answer? So wherever you fall on the political spectrum, whether you're a small government or a large government, whether you believe that government is incompetent or whether you believe they're effective, what we do know about them is that they move slowly, it's messy, and it's subject to somewhat of political whims, maybe a little more lately. So if we look at the change between the last administration and this administration, you wouldn't want to rely solely on government to solve your social problems. So to me, all of that speaks to the value of the private sector playing a really important role in this. So when I left Schwab Charitable, I contacted Christina Levenhoven, and I've just slaughtered her name for about the 10,000th time, so I call her Christina Lionhead, because that's what it means. She happens to be my business partner and a woman I adore, and she started the social finance practice at JP Morgan. And I said, we should start an impact investing business. And we didn't even know what we wanted to do at the time. But what we knew, and when I was at Schwab Charitable, I skipped over this part, we had started to experiment with impact investing within the donor advised fund. So we had done a guarantee fund, we'd done about a $10 million pilot. And all of those things converged to have me really feel optimistic about the promise of this area. So then we engaged Ben Thornley, who has written the most recent book on impact investing called The Impact Investor. He wrote it with Jed Emerson and Kathy Clark from Duke University. And the three of us looked at the industry and said, what's missing? Well, nobody knows how to do this. So we launched this strategy consulting firm. And as was said, we do three things. We offer business strategy to people in the impact investing space. We give consulting advice on how to launch products, how to launch vehicles and platforms, and we do market and landscape research. And the kinds of clients we've had in very short order, which tells you there's an increasing demand, has been Ford Foundation, JP Morgan, KKR, TPG, Gates Foundation, Rockefeller Foundation, OPIC, USAID, all in very short order. So that really gives you a signal that something's starting to happen here. So what is this all about? When I taught impact investing here at the business school about 3 years ago, I think, 4 years ago? Yeah, 3 or 4 years ago. This question was asked a lot, and I'd love to tell you at the end of my course they had the answer, but I think they were still asking it at the end of the course. How many of you in this room have asked that question? How many of you feel like you have the answer today? Yeah, a few of you. I'm not sure I have the answer. So those of you that think you have, let me know. Anyway, here's one definition. This definition comes from Bridges, and this you may have seen before if you've been in this space, you have. So on the right-hand side is really the nonprofit sector. It's grant money, it's give your money away. On the left-hand side is financial only. And then responsible investing, I think there you go. Responsible investing is mostly screens. Sustainability is sort of the long-term view of markets and taking into account absorbing resources that may not be easily replaceable. The difference between, and that's often referred to as taking into account ESG factors, environmental, social, and governance factors. And then the green bar, the difference between the green bar and the blue bar is the blue bar you're actively managing for impact. It's the most expensive way to do it, but it's the most accountable way to do it. In the blue bar, you may screen for these things in a proactive way. What impact will we have if we get in there, rather than a screening out bad activities? It turns out, by the way, in terms of responsible investing, the sin stocks perform pretty well. Gambling, pornography, tobacco, alcohol. So you do have a lot of competition when you take the sin stocks out. But Aperio, which is an index fund manager based in Sausalito, has actually done some very interesting work about taking, in public equities, taking out certain stocks, and has found that it really didn't affect the portfolio dramatically in terms of performance, despite what I just said about the high-performing sin stocks. GEN, which is a network of that was founded by the Rockefeller Foundation to promote impact investing and does a variety of things, including thought leadership stuff, defines impact investing as investments made into companies or organizations and funds with the intention, and that word intention probably should be in bold, to generate social and environmental impact alongside financial return. Anybody have any questions or comments about that? It's sort of hard. It isn't perfect. But the idea that you do it intentionally has created a bit of controversy, but is probably the most accepted definition today. There are people that say that if they invest in a utility in Burma without any intent of reaching the bottom of the pyramid, but they end up getting electricity to the bottom of the pyramid, does that count? And you can see why not having intention or having intention is such a controversial topic. But for the most part, people believe that you can't, if you don't have intention, that it's not resilient. That when you change owners, when you feel economic pressure, that you're going to move up in terms of the wealth of the consumers, and you're going to lose that impact. So who's trying to invest this way? I remember when I was running Schwab Charitable, and I said to Chuck Schwab, I really want to put some impact investments on the platform. For those of you that don't know what donor-advised funds are, they're basically savings accounts for people to give their money away to philanthropy. But while the money waits for it to be given away, it sits in investments. And historically, they were mutual funds. And then we pioneered the ability to invest with a little more diversity than mutual funds. And he said, Kim, he said, it's hard enough to make money without adding that burden to it. So he would really appreciate this sentence. This doesn't tell you how many people are fools, but it tells you how much dollars is moving in this quote-unquote foolish direction. And this comes from a survey from GEN of 158 primarily institutional investors, including organizations such as Ford, JP Morgan, and TIAA-CREF. Now you want to have some context for that? It's very small. There's $71 trillion in AUM in the world and $77 billion in impact investing. That's 922 to 1. You want more context for that? The BBC says those are the odds of Bono becoming Pope. Okay, so here's the market. This is philanthropy, which, by the way, individuals in the US are the most generous in the world. More Americans give to philanthropy than any other country in the world. It's about 2% of the GDP. But here is the global AUM. This is what they're saying is sustainable, responsible asset management. Those are mostly screens or investments that have taken into account ESG, environmental, governance, and social factors. I did that out of order, but you know what I'm talking about. And then that little teeny tiny red dot is impact investing. And I also am a tiny bit skeptical about the 23 trillion. What I'm not skeptical about is the growth. This is not huge. It's not a compounded annual growth rate of 50% or 60%. But all indications are that this sector is growing very rapidly. You'll notice that the AUM on this slide is a little different than the AUM on the other slide because this is a subset of the previous slide. because they weren't able to get 3 years of data if they sticked with the whole population. So the market is complicated because you remember that spectrum. How do you define it? It's poorly understood. We're still struggling with the definition and taxonomy. It's small, but it's growing. So where do you find social enterprise funders? Here I am talking to an audience of mostly social enterprise entrepreneurs. I hate to tell you, it is a little like this. The early stage impact investors are essentially high net worth individuals, family offices, foundations doing program-related investment, which is actually a very small portion of foundations, impact accelerators, and venture capital firms that focus on impact. I'll just briefly explain the difference between a PRI and an MRI. So a PRI, which stands for program-related investments, foundations are required to distribute 5% of their assets annually on a rolling basis. I think it's a 3-year average rolling basis. The Ford Foundation 20-odd years ago went to the IRS and said, we think we can do more social good sometimes by lending or investing in organizations than by giving them grant money. And the IRS said, okay, you can do that if the market won't do it. And that's what we call program-related investing. So a foundation, as part of their 5% distribution requirement, can make investments in social enterprises as long as the market can't do it and it has real demonstrable social and environmental impact. MRI, which is not listed here, stands for mission-related investing, and that's when an endowment, usually a foundation endowment, says that they're going to take their traditional assets and they're going to invest them in a way that aligns with their mission. Usually that is not the whole portfolio. There are a few exceptions in the world. Heron is moving to 100% invested, impact and MRI invested. Mostly it's a carve-out, and it's usually a carve-out of the public equities niche. And since the private investments or alternative investments usually are a pretty small percentage of a portfolio, something less than 15, often less than 5, you can imagine how small these carve-outs can be. But it's a start. And when we talk to clients and foundations about how to get started, we take the board of directors through a process in which we try and figure out what their goal is for getting into impact investing, what values they have, what their risk appetite is, how much capital they want tied up. If they have less capital to grant, can they tolerate that? Is this about capital preservation or is it about maximizing return? But you can understand why this is coming up, because if a foundation that has a program area in reducing carbon and they're granting $25 million a year to reduce carbon, and on the endowment side, they're investing in fossil fuels, you can understand why there's a conflict there. So those investors that we just described on the previous page, these are the stages. This is also from the Gen study where they're investing. So for the social enterprise people in the room, it's 72 individuals and a very small percentage of the AUM. And as you would expect, more money as something matures. It's not at all surprising. But this is where at this end is where the pain is. However, there's a lot of work and a lot of interest emerging in philanthropies and foundations about how to prop that up. We did this slide for USAID, and USAID was trying to figure out what role they could play in stimulating private sector capital in developing world. And they were trying to figure out where in the spectrum of maturity of an investment they should play. The orange ones we highlighted for you here today because it's most likely where you would go for fundraising if you were doing a startup. There's very few impact investors that are going to do direct investments in social enterprises. They're most likely going to invest in a fund. So you're better off trying to go to a fund and try to become part of a fund than to a standalone. The exceptions to that are the things on the previous pages where we talked about high net worth individuals and PRI and the accelerators. So if I were a social enterprise, I would be investigating these organizations and see what you could do to take advantage of these. So there are, here we are today at the Global Social Venture Competition. There are fellowships, usually associated with universities, nonprofits, or foundations, and they offer a whole range of services for social entrepreneurs. There are accelerators, and in general, they have fixed terms. They have cohort-based, a whole cohort goes through together. They offer mentorship and education. It usually culminates in a pitch, very much like the experience that you're having here this week. And they often provide seed capital in exchange for equity. The incubators are generally longer term. They usually provide some kind of business support, for instance, office space. They often have a geographic focus. Sometimes they'll have a topic focus. They generally don't invest directly, other than the in-kind contributions that they're making in terms of mentorship and office space. And then, of course, there's competitions, and you're familiar with that. So how do impact investors make their decisions? Well, here's a very, very oversimplified traditional investor decision matrix. You generally start with macroeconomic indicators. Do you believe in the sector? Are you bullish on tech? Or are you bearish on tech? What's the geography? If it's an emerging market or it's a global investment, what do you think of the macroeconomics and the geography? Then you sort of look at founders, product, industry, and you work your way down the decision tree. Is that pretty consistent with what you know about how decisions are made in investing? I mean, obviously, there are pages and pages of due diligence documents, but that gives you a pretty good sense of it. This is what happens in impact investing. This is why it's hard. And it's also a little bit frustrating. You start with often, I keep waiting for the day where somebody says to me, I don't care what the cause is. I just want to do good with my money. It doesn't happen that often. It happens occasionally, but rarely. It usually starts with a cause or geography. And then in terms of these four things in orangey gold, the type of impact, the scale of impact would be sort of, are you handing out eyeglasses, or are you providing housing and childcare? Well, scale actually is it going to be 10,000 people or 1,000 people? Depth is the eyeglasses versus housing. And impact alignment is self-evident. Does it align with your values? And then you run through all the same due diligence that a traditional investor would run through. So you're essentially doing double due diligence. It's why it's expensive. It's why the big institutional investors rarely get there. When we were talking to USAID, they said, well, if we provide guarantees, if we provide first losses, if we provide technical assistance, can't we draw in some of the big institutional investors into our market? And the answer is, if they can't get a yes here, you won't even have the conversation about this part. But that doesn't affect you guys, because you are much earlier stage than that. So by the time your enterprises are at a stage, or a fund is at a stage where it's trying to attract institutional investors, it might be there. So this is trying to capture the levels of impact. So when you think about your enterprises, you want to think about how you're going to measure impact, how deep you're going to go, what you're trying to accomplish. So obviously, if you start on the left-hand side, that's sort of the easiest. The management team is impact motivated. That sort of gets to the intent piece. You can see why you have the most players there. It's not a terribly high threshold, although I would encourage all of you to go read Enron's value statement before you get too comfortable with people's intent. Impact committed means that the products match the intended goals. Impact certified might be B Corps, might be some kind of evidence that it really is having an impact. Proven impact is the beginning of measuring it. So you can attribute the intervention to specific outcomes. And then cost-effective impact, which is what we call SIBs, which are social impact bonds, and pay for performance. That's the hardest to measure, very complex, independent valuation. Where most of you are most likely to play is someplace in this space, probably. If you stay over here, you have vulnerability around the resilience of impact. Because if the business changes hands, you invite in new investors that aren't motivated, you get squeezed financially, then the conflicts between impact and financial returns emerge, they're ahead, and you may say to yourself, I'm going to compromise just a little bit, and then you're on this slippery slope. So probably most of you will live in this universe. This is a little too extreme. So is it easier to raise money as a for-profit or nonprofit? I've been asked this question a lot, and I really don't have an answer, just like I still can't tell you what impact investing is. But here are some things you want to think about when you're making this decision. So what's in the orange stack are the different kinds of corporate structures. Some of them are traditional corporate structures. And some of them, like a benefit corp, a B Corp, are not traditional. In general, investors are more comfortable with traditional corporate structures. But one of the reasons you consider alternate corporate structures, again, is to protect the impact. If you sell your company, you have a change in governance, you want to have some teeth in that. That's one of the reasons you do that. It sometimes is used as a marketing tool. You know, it's just, it's qualified, you know, it speaks to your intent and your culture when you're a B Corp, for example. What you find in the business model column is the first is obviously donor supported. This is giving your money away. The example here is Save the Children. Profit purpose tension. This is where you live with the tension between your profit and your purpose. You know, this is buy one, give one free, like Tom's Shoes. Ethical supply chain, like Method. Direct employment, like Hot Bread Kitchen and Orion. Orion is a supplier to the aerospace industry in Seattle, and that employs hard-to-employ people. Thank you. Environmental sustainability, and then cross-subsidization. Dial 1298 is an ambulance service that provides ambulance services at the bottom of the pyramid that are subsidized by wealthier providers. And most of this you serve the bottom of the pyramid, delight, two-sided marketplaces. This is pretty self-explanatory. There are experts on helping you pick which corporate structure fits you best. And all of these categories choose different corporate structures. So what's the future? I think it's pretty optimistic. The Certified Financial Analysts Institute did some research recently. It was just published, I think, yesterday, or at least this week, of over 1,000 investment decision makers in companies. And among those, 70% agreed or strongly agreed that environmental, social, and governance factors will be increasingly important in investment decisions in the next 5 to 10 years. They talked about 4 trends in financial services that they considered disruptive. Obviously, fintech and robo-advisors was one, but purposeful capital was another. So we are bullish on the future, despite the fact that I showed you magnifying glasses and needles in haystacks and little red dots compared to the big market. It's a really exciting space. And I'll end with Andy Sigg and David Bank. Andy Sigg is the global head of wealth management at Merrill Lynch. And I'll let you read the quote yourself, and I'll open it up to questions. We've got about 5 to 10 minutes for questions. Yeah?
So, if you can repeat the question.
Yeah.
So, as you started Tideline in the last 3 years, you mentioned that you've seen a lot of change and growth in the types of organizations interested in impact investing.
Mm-hmm.
What would you say are the biggest challenges that you guys face in giving kind of productive advice to the kind of clients you get?
Okay, so the question is that I had articulated that there was change in the last 3 years since we founded Tideline and growing interest. So what were the biggest challenge that the impact investors face? That's a hard question to answer. I could answer the question pretty easily about what is the biggest challenge for Tideline. But for the impact investors, I still think evidence that they're having an impact is probably one of the hardest. And finding product at scale is a second one. It'll be interesting to see over time how resilient impact is as leadership changes and governance structures move around. But I would say finding product, finding it at scale, and then ensuring that they're having the impact that they intended. Sometimes, probably the biggest hurdle for getting started is fear of the unknown. What's this going to do to my investment portfolio? How much of a compromise am I going to have to make on returns if I'm going to have to make a compromise? Cambridge has done some research that has indicated that actually in the case of ESG factors that it can be risk mitigating. And if you think about it, it's logical. If transparent governance, if regulatory compliance, if employee safety is something you're taking into account in how you're managing your company, you're bound to reduce the risks, which will reduce the volatility of valuations, which is stable from an investment standpoint. So it makes perfect sense that would be the case. Another question? Yes?
I've been really interested about learning about social return on investment, and it's also something very nebulous that it's very hard to define, and I haven't been able to find complete information. Is this actually something being used to assess the impact of certain efforts?
Sure. So the question is that she's been trying to find some information about social return on investments, and is it being measured, and is it being used? The answer is yes. The social part is the hardest. The environmental area has probably done the best job. Governance is sort of okay. Social's particularly hard because you can solve it in one area and unintentionally affect another. And it is so complex, social issues are so complex that if you decide to measure one thing, it may not truly be reflective of what you're trying to accomplish. But Jen has done a lot of work there, so I would look around the metrics that are there. Some funds that we see develop their own metrics. The impact investors want to see what the impact is of their funds. So some of them develop their own metrics. Some of them outsource to firms to do the measurement for them. And some of them use universally acceptable measurements like those developed by Jen. Aaron, do you have anything you want to add? Just so you know, Aaron works for me, and he's really talented. Yes?
In my experience in this kind of field, this kind of investment is really a hands-on thing. You know, it's not like you buy stocks or you invest in a mutual fund, or even have a board member, but I think you really have to be involved on an ongoing basis in the operation, expansion, growth of the country. How does that fit with PRIs? Foundations don't really have that capacity.
Yeah.
Is there an intermediary role for Tideline
Sure.
accelerators to actually get involved on a day-to-day, week-by-week, month-by-month basis
Sure.
that lowers the risks for people who are just doing portfolio investing?
Sure. So the question is, in social enterprises, in order to get them off the ground and to have these dual obligations or aspirations, requires hand mentoring and day-to-day support of management and real deep involvement. And how do you do that in kind of an institutional way? The answer is that it's slowly, there are tools and players in the market that are developing to do just that. So the funds, the impact funds, they do a very good job of helping management of these companies figure out how to go about this, how to monitor it, how to measure it, how to stay close to it. There are firms, consulting firms, that help as well. Tideline doesn't do a lot in the impact measurement space. It's not our forte, but there are firms that do that. The PRIs and foundations, actually, they have dedicated teams, and they actually do know how to do that quite well. They will stand side by side with enterprises, and most of their history is in the community investment space, low-income housing, but they will, and a lot of infrastructure investing, but they know it quite well. They'll help people partner together and find the technical assistance they need. They will fund grants to get the technical assistance to these enterprises that they need. It's much harder in the lowest income countries, but everything's harder. I mean, the lending environment isn't in the right currency. It's hard to get the entrepreneurial education you need. The whole system is harder in those countries. But even there, you can get technical assistance grants. There's mentorship programs and all these accelerator programs. Some of the graduate schools, the business schools are offering support. Santa Clara does a lot in this space. Duke does a lot in this space. Yes?
Question about impact investors. As amorphous as impact investing is, naturally there's amorphousness around this term. Lots of people are tossing this phrase around. Are there standard guidelines that you see emerging for people who can actually describe that?
Well, I'm glad you asked that, because Tideline has just done a piece of research around this, and we're continuing to do it around bridges. We call it impact classes, and and if you go to the Tideline website, you'll find some information about it. It essentially is a way for an investor to put themselves in the spectrum and figure out where they fit in this universe of impact investing, because it isn't. We really don't have words yet to describe where you fall. Are you an investor who just doesn't want to do any harm? Are you an investor who wants to combine your philanthropy and your investing? Are you an investor who wants to make sure you don't lose any money, but you're willing to, you're not motivated by maximizing return? Are you an investor who wants to ensure that you get market rate returns, but you want to find somebody who's an expert that can help you do that in a way that has an impact as well? And then what's the geography or cause or issue that you care about? And then how are you going to check and see if you're achieving it? So all of those things, that the investors are not made in one shape, size, and color, and the investments aren't. But Tideline has been working at finding ways to create taxonomy around this so that when you think about where you fit in this universe, you have a way of describing it and identifying yourself. Another question? Yes?
Even if it's a small part of the market, as you say, everyone is looking about impact investing. For example, Goldman Sachs bought in green.
Right.
JP Morgan invented the shares. So these guys, they don't have the vision, but they have the instruments. On the other side, a small player, like, for example, in Europe, Triodos Bank, they don't have big instruments, but they have the vision. So what's your personal position? What do you think an investor has to trust? More these guys going on the leisure, or more the small one getting instruments?
Yeah. So the question is, there's a lot of talk, despite the fact that I said that it's only $77 billion. And that in some places, you know, he used the example of Goldman Sachs buying Imprint as an indication that they're committed to the space, and then talked about in Europe how there is more broad-based commitment and vision about how to get there, but they don't have the tools and the instruments to get there, and some of the financial services firms in the US do. I think that's giving too much credit to the financial services firms in the US. I would actually argue that we're behind Europe in every regard. If you look at what Big Society Capital's done and some of the merchant banks that are in Europe that are trying to do impact investing, they're way ahead of us, despite the fact that Goldman made that acquisition. So I think we have to look to Europe to see how they're doing it, and I think we will continue to. But I'm excited by the interest. You know, you don't know if this burgeoning interest is indicative of something more. I think we have time for one more. Yes?
What do you think is the value for startups to get money from impact investors? What I've seen is that once I've been involved in many startups before in the impact space, but what I've seen is that when you're going after impact investors, although it seems like a sweet spot for impact startups, it hurts your relations with financial investors who are just looking at the financial value.
Yep. So the question is, if you're a startup and a social enterprise, is there any stigma by going after an impact investor in terms of what it signals a traditional investor? Will a traditional investor assume, because you were first funded by an impact investor, that somehow your returns are not going to be market rate? And the answer is yes, to some extent that signal exists. It's going away. I think that you don't necessarily lead with your impact investors. If you can anchor with a traditional investor, it's an advantage. But the reason most social enterprises go after impact investors first is because it's an easier, usually, to secure that money. But there is no question that there's some hangover from the perception that you're going to have concessionary returns if you're supported by impact investors. And so you then have to sell the story even more strongly that you're trying to achieve market rate returns so that you don't signal that to traditional investors. Okay, well, thank you very much. It was a complete pleasure.